Good day, everybody. Welcome to this quarter's e-commerce brand valuation webinar. My name's Emmett Kilduff. I'm a co-founder and CEO at the Fortia Group. In terms of today's agenda, we'll start by giving a brief update from the Fortia Group. Then, as ever, we'll give a walkthrough of the report. I'll be joined by two great speakers, and we'll leave 5 to 10 minutes at the end for audience Q&A. To submit questions, please do so via the Q&A tab on Zoom, not via the chat tab. That makes it much easier for us to review and field questions. And finally, from a housekeeping perspective, this deck and the recording of this webinar will be available to all attendees in the coming days. So let's jump in. Part one, an update by the Fortia Group. Our mission at the Fortia Group is to become the leading e-commerce investment bank for the lower and middle market sector. As many of you know, I'm ex-Morgan Stanley, one of the leading investment banks in the world. We're seeking to bring that level of brand and service to lower middle market, so small, medium-sized e-commerce brands, and we're also obviously working with the buyers as well. That's our mission. To give you a feel for our deal flow at the moment, on the M&A side, we are selling a house of Amazon FBA brands that's doing 30 million in revenue. It has received LOIs, and those LOIs, one with the preferred bidder will be signed potentially next week. We're coming to market in the coming days with a 20-year-old DTC sportswear brand. We're advising 3 aggregators on the sale of their non-core brands. Increasingly, that's a trend. Aggregators obviously acquired a lot of brands over the last few years, and there's been changes of strategies, and we really like working with aggregators to sell their non-core brands. And finally, there's a lot of mergers and acquisitions happening amongst acquirers such as aggregators, and we're delighted to be working on one of those. And in that case, a term sheet has been signed, and it will the deal will get signed itself in the near term, and look forward to telling you more about that. Other engagements, just to give you a flavor of what we're working on, we do buy-side mandates with private equity firms. This is an example. We're actually engaged by the corporate, which is backed by a big PE firm in the States, to identify over-the-counter brands to acquire. And as I'll give you more detail about in a moment, we're doing brand audits for entrepreneurs to help them think about how to increase the value of their businesses over time, and brand audits from an acquirer perspective to jump into diligence and valuation of brands. To build on that, so what do I mean by brand audits? There's broadly 5 inputs to our brand audits. It's a kickoff call with the seller, the brand owner, a detailed due diligence questionnaire, which we spent 2 years developing, obviously looking at all the financial statements of a brand, working with a few of our partners who analyze the data. So it could be a firm like Capoc, Conjura, Quantacap, these types of firms, Carbon 6, a multitude of firms who can analyze data to give us ammunition for insights. And then diligence calls, where we go through all the findings and due diligence that with the entrepreneurs. That results itself in the output, which is a detailed deck. The data goes with the deck. So we look at everything from the macro conditions of the e-commerce space, the sector, valuation trends, the specific category of the brand, and our observations. And then the lion's share of the analysis is about the brand itself. What, from an acquisition perspective, are the highlights? Talk about the brand equity, analyze the products, the supply chain, look at everything from channels to marketing, growth opportunities, detailed financial analysis, look at the legal side of things, identify red flags, and ultimately give our view as to what the valuation is today and maybe where could that be. So if you're an entrepreneur, a brand owner, and you're interested in an audit to understand where you are today and what could increase value, please reach out. And if you're an acquirer, for example, a private equity firm, and you'd like some diligence done on a brand, again, please reach out to learn more. The best investment banks in the world are very close to buyers, and we take this to heart. We're uniquely positioned in that we know the buyers of e-commerce brands very well. A simple example of that is we're the only firm to have a WhatsApp group with C-suites of acquirers. Today, there's 107 C-suites, excuse me, on that WhatsApp group. And so we're in constant dialogue with the people that matter. And we're building that all the time, and we'll make a big focus of adding more PE and strategics as we go into 2024. As we look to 2024, our next conference, following great conferences in New York and London, is back in New York on January 16th. The conference is for acquirers, investors, and lenders to the e-commerce space. It's not for brands, apart from maybe 5 brands that we handpick that want to pitch their exits to the audience. So if you're an acquirer, and that can be an aggregator, a private equity firm, or strategic, please reach out. We'd welcome you to join what will be the biggest e-commerce acquirer conference to date globally on January 16th. Okay, so enough about the Fortia Group. Let's look at the report. As you know, we started producing these reports earlier this year. It's the most common question we get asked at the Fortia Group: what are you seeing from a volume, from a valuation perspective? So we decided to productize our IP, if you will, into these reports. Essentially, in our view, there are 6 key factors that drive valuation, and it's too simple to sort of say it's revenue growth, net margins. There's a lot of things, some outside the control of the entrepreneur, some under the entrepreneur's control. So that's why our report has 6 sections that ultimately lead to valuation. The first, global M&A activity. The second, e-commerce trends. Third is public market listed comparables. Fourth is e-commerce M&A activity. And then you change and we go under what's under a brand's control, which is brand metrics, deal dynamics. All that leads to valuation. The report is very long this quarter. We don't intend to go through everything. So what we'll do is we'll skim some of these topics, but we're going to focus on 3 today. I'm delighted to welcome 2 very accomplished speakers who can take the lead on 2 of those sections. So John, who I'll ask to introduce himself in a moment. John, Daniel, please turn on your cameras. John will present the e-commerce trends section. Daniel will present the brand metrics section, and then I will finish by giving our house view on where valuations are at today. So John, Daniel, in that order, can I please ask you to introduce yourselves?
Yeah, my name is John Fetto. I am the head of e-commerce insights for Grips Intelligence, and happy to be here today.
Yep, I'm Dan McCarthy, assistant professor of marketing at Emory University and co-founder of Theta. So you're really excited to talk metrics today too.
Welcome, gents. Okay, so global M&A activity. Let me canter through this at a pace. Look, it's interesting. There are mixed views today on what the outlook is. This is a survey done of European strategics and private equity firms, but I believe it's a good proxy for the global market. 35% expect an increase in M&A activity, whilst 43% expect a decrease. So it's not really clear either way if it's going to increase or decrease. Hopefully that becomes more crystal clear as we get into 2024. The good news is, from a volume perspective, the number of deals, the unit number of deals has increased significantly in the last few quarters. The total dollar value may have decreased, but the unit number is going up. So there has been maybe a bottoming out in Q1 in terms of number of deals. We've come off that bottom, as you can see in both charts in Q2, which is, bodes well. From an M&A trend perspective, it's interesting to see that private equity firms are more optimistic than corporates or strategics. And there's a lot of detail here. Forgive me if we're going to do this very quickly, but obviously, please do take the time to review the report after the webinar. From a seller rationale, thought this was fascinating. What are the top 2 reasons for selling? One is distress-driven M&A. We've seen that a lot, especially maybe with DTC brands who are finding it difficult with their customer acquisition costs. And 2, non-core asset sales. We've already seen examples of that. I've mentioned we're working with aggregators to dispose of non-core brands. So it's interesting to see that come through this survey. What are the drivers of M&A deals according to acquirers? Number 1 is undervalued targets. So there is some good value, obviously, for buyers. Maybe it's because they're distressed. cash-rich corporate acquirers, just like private equity, there's a lot of strategics or corporates with a lot of dry powder. We'll show you some stats on that later on. So they've got money to put to work, which is driving a lot of deal flow. What are the obstacles to deals at the moment? Well, according to acquirers, the number one obstacle to M&A is inflationary and interest rate pressures. And the M&A is at a seven-year low. It's obviously a tough economic environment for M&A. There has been a little bit of an uptick in terms of number of deals. Hopefully that gets better as we get into 2024 and inflation and interest rates become a little bit more under control and predictable, and that will help boards and acquirers want to do more deals. I thought it was really helpful just to bring this slide up. I know we're focused on M&A, but the overall capital markets is important, and IPOs is a good litmus test as to where people are from a risk on, risk off perspective. If you look at the light blue chart on the right here, it's the actual proceeds raised by IPOs in September of this year was the highest since November 2021. So that bodes well. And as we all know, a couple of those IPOs were e-commerce related. So great to see the IPO markets reopening somewhat, and hopefully that will continue to Q4 and beyond into 2024. That's all I wanted to say in terms of M&A activity. Now I will hand over to my colleague to talk about e-commerce trends.
Great, thanks. So I am the head of e-commerce insights from Grips Intelligence, where our mission is to make all e-commerce transactions visible. And part of the way that we do that is by reporting on the e-commerce revenues, transactions, average order values across tens of thousands of global sites and growing every day. What we're looking at here is our ability to drill down beyond just the top level domain metrics, but into the subcategories as well. And we are measuring dozens and actually hundreds of different subcategories, but we're looking primarily at the level 1 categories here and looking at both their year-over-year change in revenue and their year-over-year change in prices. And when Grips looked at that data from August 2023 to August 2022, our September data will be available in a couple of days, we saw that on average, e-commerce revenues increased by about 7.8% on average overall. Prices held very steady. I think they were up about 0.2% really. So you'll see that red line here in the middle. Anything to the right of that line is exceeding or growing faster than the e-commerce average. Anything to the left of that is growing a little bit slower. I think that there are a couple interesting trends here. We see beverages really far out there on the right is the fastest growing category that we are measuring right now. And we'll drill into a few of these, including beverages, in a couple of minutes. Food is another one, although prices for food have dropped a little bit over the last year. That was obviously a category that was heavily impacted by inflation, but those prices are coming down. Animals and pets are another category that are fast growing. Categories that are struggling seem to be like furniture. Maybe there's some interest rates or mortgage issues that are dragging that down. Apparel and accessories are growing a little bit slower than average. But in general, all of the categories that we are tracking have shown positive growth year over year, which I think is a really good sign. If we go to the next slide, we drill into that beverage market, and I think this is one that's been really interesting to me. I mean, beverages have been a notoriously difficult market to crack into for e-commerce just because they're expensive to ship, because they weigh so much. And you can see one of the reasons that this category is growing is because alcohol is really increasing. That's a price point that makes it worth their while to ship, and it is one of the fastest growing subcategories within the beverage industry that we're tracking right now, growing at about 28% or so year over year. And it's definitely the biggest revenue generating category within the beverage market online. Soda, I think that would be a much bigger category in store, much smaller in terms of e-commerce, but it is actually growing at an even faster pace. I think part of that might be due to the ability to ship kind of those soda stream like condensed sodas that are becoming a little bit easier and more efficient to ship. But worth noting that the soda category is growing. I think another really interesting trend to point out here is the difference between like the milk, dairy milk and non-dairy milk. And the last year, non-dairy milk rather has grown at a faster pace than dairy milk, putting them about average in the e-commerce space. Obviously, that's a different category that we're seeing in the total e-commerce and total retail space, but online dairy milk and non-dairy milks now have become a little bit more on par with one another. Drilling into the top brands that are growing here, I thought it would be interesting to show some of the top alcohol brands, and we can see these are the ones where they have grown their revenue the most, or some of the brands that have grown their revenue the most. And topping that list was Tito's, but you could also see on the previous slide, there we go. Tequila brands are kind of dominating the fastest growing list. So tequila is kind of having a moment, especially online, with people increasingly ordering alcoholic beverages and specifically liquor and spirits online. We go into the next category. So looking at beauty, obviously, beauty is a category that is eternal. People are always spending in this category. We have like the lipstick index, if you will. And I think that one of the things that's really driving the beauty category is still the return to office. I know we've been talking about return to office now for many months, but we're still looking at year-over-year changes, and consumers in August 2023 were still continuing to spend more on beauty items than they were a year ago. Leading that increase is shaving and grooming. People being back in the office are investing more in shaving, grooming, perfume and cologne, hairstyling products, things that maybe they were spending a little bit less on or doing a little bit less frequently when they were camped out at home. I think one of the other things to point out here, if we're looking at the brands that are showing more growth year over year and brands that are potentially losing market share, among the top 10 or 15 brands that were gaining market share, the average price of those brands was about $21. And if we look at the brands that were growing the slowest or actually losing market share, the average value or the average price of those brands was about $45. So there does seem to be a trend where more affordable brands tend to be those that are increasing the fastest, whereas more expensive brands are increasing a little bit slower. And then when we look at some of the fastest growing brands over here, we see Cosrx, Patchology, Glow Recipe, Biore, and Clody. Patchology and Biore and Cosrx, I think, are retailing for about $17 or less, whereas Glow Recipe and Clody are like $37, $45 on average. So it's not a hard and fast rule. You can definitely see some higher price brands growing faster than others. But in general, the trend that we're seeing in the beauty space is that people are trending down to maybe more affordable brands. Okay. And we go to the next slide. The pets market also, I think, is really one to keep an eye on. If my background weren't blurred here, you'd see a couple dogs walking around. Obviously, we saw a really big growth in the pet space in the COVID years, and those animals now are reaching the age of 2 to 3. So it's normal that those dogs and cats and other pets that were adopted during that period may not need the growth, need puppy products and things like that as much as they would anymore. And also economic pressures are increasingly talked about hitting this category, but we are still not seeing the pet category contracting in any significant way. We're still seeing very strong growth. One of the categories that people have talked about trending down have been in the treats category. We're still not seeing that either. Dog treats was, in fact, the fastest growing category in August, year over year, followed by cat treats. There was a really interesting trend that we'll talk about on the next slide for dog treats. But in general, I think we're also seeing back to work driving some of the trends in the pets marketplace. People who are feeling a little bit of guilt leaving their pets alone for more time than they would like are investing in things like treats, kennels to keep them safe and contained while they're away, cat furniture to keep them entertained, things like that. So we are definitely seeing continued growth in this category. If you go to the next category, the next slide rather, we'll take a look at some of the fastest growing brands in the category and some of the slowest growing brands. For this one, I had to really narrow it to a subcategory, and I picked dog food and treats because I think it illustrates what we're seeing a little bit more significantly. Greenies was just the case that was a really saw a really strong spike in the month of August. Has since come down, but we've definitely seen Greenies ran a campaign in August with designer Christian Siriano, where they were offering some hound toothless trench coats for dogs and their owners, and saw a really big spike in sales of Greenies, which is a dog treat for animals. Since then, that's come down. But if you look at the fastest growing brands and the slowest growing brands, we're not really seeing really strong indications one way or another. We are starting to see maybe some of those higher end brands that tend to be a little bit more expensive, like Origin and Canaday and Merrick, slowing down a little bit. But we're also not seeing that across the board. Fresh Pet is another fresh pet food item that is showing growth year over year. So we're going to keep our eye on the pet space specifically, but what may be happening here is where we're seeing a little bit of a split, people who are downgrading a little bit to more affordable brands, but then also on the higher end, people staying high and investing in spoiling their pets as they may return to the office. So again, something to keep a really close eye on, but we don't think that this category is shrinking just yet. Again, happy to answer any questions at the end or in follow-up, but that kind of concludes the brief overview of e-commerce trends.
Thank you very much, John. If you have any
Sure.
questions for John, there's already some coming in, John, for you to take a look at there. Maybe, John, can I ask, from your perspective here today, how does Q4 look like?
I mean, I think we're definitely seeing trends towards a strong holiday season, but we're not expecting really big growth in that space, at least compared to last year. Consumers were a little bit cautious last year, and I think we're probably going to see fairly stable numbers with 2022. But we're keeping an eye on that. We're actually going to be reporting e-commerce trends day by day throughout the holiday season from November 1st on. So if you want to keep a track on how the categories are performing, check us out.
Very good. Thank you.
Yeah.
Okay, let's move from there to public market comparables. We first of all will take a look at the e-commerce DTC index that we reference. The median for the EV to sales valuation was 1.15x on the last recording, and EV/EBITDA is 6.3 times. That's the median for 30 plus listed stocks, which I'll show you in a moment. Obviously, focusing in on EV/EBITDA as the main multiple, 6.3. You can see it's hovered around 6 to 7, maybe slightly higher for quite a period of time now, since the highs of the COVID bump. There hasn't really been that much deviation. Slightly on a downward trend over the last few months, and hopefully we have a good Q4 to the previous question, and we can see that bounce up as we go towards the holidays and into 2024. If you look at the components of that index, there's a broad variety going from Laird Superfood, $36 million revenue LTM, all the way to Lululemon, which is obviously a multi-billion-dollar company. But it's interesting if you take the time to look at which businesses have good both gross margin, net margin, and what are the resulting valuations. And happy to discuss any of these brands with anyone who wants to dig in deeper. And I can also dig out some my former employer Morgan Stanley's research on some of these stocks, if that's helpful. Okay, so going from like listed brands, individual brands, let's take a look at listed aggregators. And most people don't realize that there are 5 listed aggregators out there. They are Aterian, AKA Digital Brands Group, and Solo Brands, all listed in the States, and the Hut Group listed in Europe. From a valuation perspective, we're showing here the ranges of EV to sales that goes from 0.08 times to 0.71x times. So below their comparative median valuation to listed brands. And like the reason we put this in here is important for owners of individual brands to sort of understand the context of what listed stocks, listed brands and listed aggregators are trading at, because it has some read then across to what range they ultimately might be able to achieve. And we've incorporated this thinking into our ultimate prediction and valuation range, which we'll get to towards the end of the webinar. For those who want to dig in deeper, looking at Aterian, obviously it has been under pressure, but there's always a bull case and a bear case. Firstly, congratulations to Joe to becoming co-CEO, and they're working towards profitability in the second half of 2024. That's their latest guidance, and it's good for all aggregators that Aterian gets there, and all these other aggregators perform well. That helps the overall space and will help IPOs of some of the private aggregators, which we hope might come in 2024, 2025. And there is a sort of what I call a quasi-listed aggregator, which is Go North, from the Nordics in Europe, and it has bondholders, sort of public bondholders, and therefore has an investor relations tab on its website. It's quite interesting to see how they're performing. This is just an extract, shows that they're doing very well. It's worth taking a deeper look if you have time. Okay, so that's the listed comps. So what about e-commerce M&A activity specifically? As before, it's important to look back in order to look forward. No doubt 2021 was the year of acquisitions, bumper year, the perfect year for an entrepreneur to sell. That's when multiples were at their highest, probably November, December 2021. A lot of the aggregators were very busy. You can see Boosted, Goja, Old Sam, all making acquisitions here, as well as Thrasio, P21. 2022 continued to be very active, particularly the first half. Here's some examples of the acquisitions. And if we look at the first half of 2023, there's been plenty of deals. Despite the markets obviously being tougher, there's no doubt the context is tougher. There's still deals happening. You can see Heroes, Razor, Foundry, Society Brands, all giving us mentions of deals that they've done. If we look at Q3, I want to just call out two examples of deals that have happened in the last few months from a private equity firm and a strategic. This is a US private equity firm called Gage Capital, which looks at consumer stocks, including e-commerce, and they acquired an Australian beauty business called Lovingtown. But fortunately, everyone asked me what was the multiple. At this end of the market, it's not always possible. It's nearly impossible to get the actual valuation. But again, it's just good to sort of see e-commerce orientated PE firms doing deals. The other example we wanted to highlight was a strategic called Marico, acquired a DTC nutrition brand in India called Plix. So again, good to see strategics who we've referenced have a lot of dry powder or cash on the sidelines, putting some of that money to work to fuel growth. Okay, from a brand metrics perspective, before Dan takes us through his thoughts on work he's done for a private equity firm, I just wanted to mention two items that can help the entrepreneurs on the webinar. First of all, obviously, maximizing, understanding your brand metrics, what acquirers look for, and getting the best financial operational metrics, getting the most optimized ahead of an exit is critical. For FBA-led brands, one way we can help you is by you digesting our nearly 80-page exit guide that was designed for FBAs and co-authored with 20 acquirers. So it's a great resource. There's a link to the guide here on the slide. Otherwise, please look at the fortiagroup.com. We have the same for DTC-led brands. It's a 90-page guide. It was published earlier this year. Again, co-authored by a lot of DTC acquirers, sponsored by Yardline and Charm, our partners. And again, it's a great read for you to really understand how acquirers think about DTC brands and what they'll ultimately look for. If you're not gearing your business towards what they look for, then you're going to be leaving some money on the table when you ultimately come to an exit. Okay, Dan, over to you, please.
All right, great to be with you. So my perspective comes from kind of wearing two hats. One is as an academic that studies kind of lifetime value and the sort of metrics that are often used to evaluate businesses like this. The main one for this audience is that I've co-founded a business that basically helps private equity firms and companies kind of work through the diligence process. And so that's the main context that I'll be kind of speaking from as we kind of go through this. So just want to make clear just a few definitions before we get started. What I thought would be helpful is to kind of go through, so again, we work with a number of kind of growth private equity firms and other PE firms that acquire these sorts of businesses. And we've continued to do a number of diligences for them. One of them is Provenance Digital. And so they're a firm, if you're looking to raise capital, they could be a good firm to be speaking with. This is the sort of analysis that we'll do for them. So it's kind of reflective as you think about your business, the sort of thing that you may have to disclose to them. So it could be good to know kind of what your numbers look like. Again, super quick definitions. Post-acquisition value. This is basically the value of a customer after acquisition. Residual lifetime value. It's basically the value of a customer relative to today into the future. Customer lifetime value is the overall net present value of a customer in terms of their profit after we subtract out customer acquisition cost. And so again, these are the sort of metrics that we'll often hear about, but oftentimes there can be some confusion as to exactly how they're defined. Just kind of what I'm going to do is I'm going to take you through one of our reports just very quickly. So if we kind of hop to the next slide. This is the sort of report that we'll do time and time again. We've probably done 130 of these on a paid basis. So we'll just kind of go through kind of these main things. Typically, they'll start with an executive summary. So if you go to the next slide, it could be something like this, where we see basically a summary of the kind of the key highlights from our analysis. But I don't want to talk you through a wall of words. This is all basically going to be unpacked over the subsequent slides. So if we go to the next slide, we're going to dive into unit economics. So this is really understanding at the customer level how profitable you are. So if you go to the next slide, what you'll see here is kind of the first high-level view where we kind of look at, again, the value of customers after acquisition. That's kind of the green line that we see in that topmost chart, and how much is being spent to acquire the customers. That's the red line. And so obviously you want to have the green line being significantly above the red line. But a key question that PE firms will often want to know is that these figures are being computed in a reasonable way. So having a third-party vendor who can come in at arm's length and compute them, like Theta, I think that's part of our value add. If we go to the next slide, this kind of transitions us to kind of the profitability payback. And so what this is showing is when you acquire a customer, typically we're spending about $43 to acquire them. But on the very first order, we're getting enough variable profit to pay off that customer acquisition cost and then some. And then as we look into future months, we can see just how much additional profitability we're getting per customer. So that view like this is often very common and to be expected. In the next slide, this is kind of another way of looking at the top line that's kind of driving the figures that we saw in the previous chart. It's basically the cumulative contribution profit, transactions, and or revenue over different amounts of time since acquisition by cohort. And so, again, this can give you a sense of how much revenue and how much profit you're getting from customers on average over different windows of time. So obviously you want to see that line moving up and to the right as quickly as possible. In the next slide, this is showing kind of cohort activity or retention. So take all the customers you acquired, roll forward the clock 4 years, what proportion of them are still making purchases with you? And so this is one where obviously higher retention tends to be better. Next slide, we'll dive into AOV trends. This is one that you'll want to be mindful of for many businesses, especially those that have hardware and then kind of repeat subscription or accessory sales. You can often see a big gap between first purchase AOV and repeat purchase. So again, these are trends that can be very relevant for a PE buyer. Next, we're going to kind of move into kind of the customer base structure. So this is kind of giving us a sense of, as we look across the customers, some are going to be better, some are going to be worse. And so we kind of want to understand that. So if you go to the next slide, this is showing us the distribution of the post-acquisition values across the customers. And it's pretty much what we always see. You can see there's a lot of customers that have very low values, $60 to $80. And then there's that bar on the right-hand side representing customers that on average are bringing in more than $280 in contribution profit. And so it can be very helpful to know what it is that makes those very high value customers different from the low value ones. Next slide. It's just giving us a sense of how the profitability of customers varies as a function of how many purchases they make. And it's kind of something that we'll very often see that the customers who only buy one time on average are not worth very much. The customers who make multiple purchases can be worth, double, triple, quadruple that of the one-time buyers. So again, it kind of gives us a sense of the composition of the customer base in terms of their purchase frequency. Next slide. This is showing us how much of the value we're getting from a customer just from the first purchase that they make versus all of the purchases that we predict to come after that point. So again, this is utilizing a predictive model as are all those other charts, but it's basically showing us that there's a lot of value to be gained after the first purchase, which can be heartening for a PE firm. And then finally, this is more for tactical kind of value creation use cases after acquisition. Also, it's very helpful for companies to know this in general. When we go to the level of segments, so I'll just kind of very quickly take you through a couple of them. If we have the value of customers, we can break it down in terms of men and women, if that's something that's available in the CRM data set. So that's what we're seeing on the left-hand side. On the right-hand side, this is showing us the evolution of value by segment over time. So we can see, for example, women tended to be less valuable in earlier years, but now they're about of the same value. Next slide. This is one that's often easier to get. It's the profitability of customers by the category of their first purchase. Again, the left-hand side, this is showing us that category 1 tends to be much more lucrative than category 11. The gray bars, those show the size of the cohorts. We can see, for example, category 5 is pretty big, and that's in general bigger than category 9, which is also pretty big, but the customers don't tend to be worth as much. So again, this could be just very helpful information to know. Next slide. We'll often see that different channels have different paths. Here we can see that acquisition channel doesn't really make a whole lot of difference. The customers that are acquired through different channels are of relatively comparable value, which can be very good to know because it allows you to then be able to focus on customer acquisition costs. The changes in CAC by channel will drive how much you may want to allocate to different channels. So again, this is just a quick view of how PE firms will often think about your metrics. It's obviously easy to focus on CLV and CAC, but there's just a lot more cuts that they'll often be looking at. And so knowing the sort of cuts that they'll be looking to can really help set you up for success in what you put in the data room.
Thank you very much, Daniel. There's already a question come in for you there. Again, if you'd like to ask Daniel a question or John, please submit it via the Q&A tab, and we'll either answer them by typing them on the Q&A chat or indeed live verbally in a few minutes' time. So we've gone through 5 of the factors that influence valuation. Let's jump into the last, which is what we call deal dynamics. So at a high level, what do we mean by that? There's several deal dynamics that can impact valuation. It could be the situation of the shareholder. We saw a survey earlier on talk about a lot of sellers being distressed. That clearly has an influence on deal dynamics. So it's good not to rush a deal, to take your time, to be in a position of strength as opposed to distressed. From an acquire situation, I'll give you 2 examples in a moment. And from a retaining advisor perspective, I'll give you an example of data in a moment. Others are marketing and distribution strategy. If you're a brand doing tens of millions of dollars, you've earned the right to present your business to all types of acquirers, whether that's aggregators, private equity firms, strategics, maybe even family offices. So you need to think thoughtfully about your distribution strategy. Synergies, what are the revenue and cost synergies that can have a big impact around deal dynamics, and have you articulated and thought through them well? And then deal structure, how much does one want up front versus deferred? Is there flex there? Is the entrepreneur or the core team willing to stay on? All those things can influence the deal dynamics and ultimately valuation. So just to jump into the acquire situation and the retaining advisors dynamic in a bit more detail, we've touched on this a little bit. Well, actually, let's take a step back. So obviously, if we look at aggregators, everyone has read the press. Those aggregators that did a lot of acquisitions during COVID it's obviously very tough environment for them. They bought at a high price. There's a lot of integration issues, and their cost of debt is high. The good news is that there are some aggregators are doing very well. There's been positive announcements by Go North, Intrinsic, Kite, SellerX, Amber this year. As we mentioned, we're putting a merger together of two firms to make them stronger. And people keep coming to me about the article about Thrasio, saying Thrasio's bankrupt. Thrasio hired those restructuring advisors, from what I'm hearing, a year ago. It's not new news. They needed help restructuring. Lots of retailers, from JCPenney to other firms, have needed restructuring advisors over the years. Of course, they needed some help because there was a lot of change, and they bought a lot of brands at the top of the market. So, don't or take all these press articles with a pinch of salt, please. There is some good things happening in the aggregator world, and there are some that are profitable at a corporate EBITDA level. So there are aggregators acquiring. It's not all bad news, and that they're not doing anything or going bankrupt. If we look at another acquirer pool, private equity firms, record amount of dry powder, and it's probably similar for corporates or strategics, but it's more difficult for any firm, even S&P Global, to acquire that data. So private equity have a crazy amount of dry powder to put to work. That's typically done in two forms. One, as a big platform acquisition. For that, you really need, low tens of millions of revenue and profitable at EBITDA level. But bear in mind, their existing portfolio companies are also interested in doing thoughtful bolt-ons or add-ons, they're sometimes called. So a business they bought for 50 million in the pet space might well want to buy a business that's even just doing 5 million revenue in the pet treat space. So that's something to bear in mind if you're an entrepreneur thinking about gearing up for an exit. Obviously, we would say this, but retaining advisors can add value. Rather than hearing us just say that, this is the best data points we can find to evidence that. University of Alabama analyzed over 3,000 deals over a 17-year period and found that strong advisors can increase valuations by up to 25%, and that more than offsets our success fees. So for the entrepreneurs listening, please reach out if the Fortia Group can be of help. Okay, so all roads lead to valuation. So before I jump into giving you some data points on valuation, I want to just talk you through in a bit of detail a new approach we had. So we've done multiple surveys of our acquirer client base over the last 2 years, asking them broadly what ranges they're bidding for brands, etc. And it's been insightful. And we were about to do the same ahead of this webinar, but we got a great idea from Ben Fletcher of the Mothership. To, instead of doing a broad poll with questions, why don't we make up 6 fictional brands and then ask our acquirer network to simulate bids. So this idea only came, I think it was Tuesday or Wednesday last week. So we've moved quickly and mobilized quickly to make this happen. So on Thursday, we finalized the wording of our poll, where we came up with 3 fictitious FBA-led brands and 3 fictitious DTC-led brands. And considering the 4-day turnaround time, the deadline was Tuesday night to give us some time to actually interpret the results. We were delighted to get 19 acquirer firms responding. Now, the majority of those are aggregators, and within that majority, the majority are FBA, but that's to be expected because there's a lot more FBA aggregators than DTC aggregators. But unfortunately, it was too short notice for most of the PE firms and strategics that we work with. They don't move as quickly as the aggregators, and certainly the PE firms, a lot of them are maybe a little bit more sensitive to giving information. However, we're delighted with 19, and next time we do this, we'll give acquirers more notice, so we'll get a better response rate. for our Q4 report. It's the first time we've done this, so bear with us as we present all this information. I'm sure that you have lots of ideas on how we can improve it, but this has never been done before that I've seen, and I think it's really exciting, but we always welcome feedback to improve our approach. So let's look at brand number one. We call it EcoNext. This is an Amazon FBA-led brand doing 1 million EBITDA. So what we showed the respondents was the information on the left. For a category, we just said, look, it's whatever is your preferred category. We rather than sort of saying supplements or pets or baby, etc. We thought it was just easier to go with that. It's a relatively small brand, 5 million revenue, good growth rate, 20% revenue. TACOS is 12%, EBITDA margin or STE margin for FBA brands is 20%, so good net margin. It's an FBA-led brand, so we're saying here FBA is 80% and DTC is 20% Shopify. So based on that information, of 19 firms that took a look at that, 13 said that they would consider a bid, and we've laid them out literally as the bids have come in. So you can see the upfront amount is the bottom piece of the bar before the white line. And after that is the deferred amount. And if they gave clear color as to what the deferred component would be, we've detailed that. I know there's a lot to take in, so it may well be that you'll absorb this better as part of the follow-up when we send out the PDF. But S stands for stabilization, E is for earnout, and O is for other types of deferred component, which could be equity or something else. So looking at this, there's significant variance in the bids. You can see everything from 0.35x up front, which is, in my view, frankly, ridiculous for a brand like that, all the way up to 2.8x up front, which is getting to be, what we would think is a sort of a fair price for a good performing brand like this. Several bids, as you can see, came in with the same multiple. The sticker price, is just a sticker price. The devil's always in the detail. How much is upfront, how much is deferred? Of the deferred, is it more likely, i.e. stabilization, or is it potentially might there be some disputes on future earnout discussions, or is it long-term like equity and Topco of the acquirer? So you can see the mixture there. A question we would pose, obviously this is a sort of a fictitious brand. In a real process, we think bidders may bid slightly higher if it was real, because it was maybe in their interest, in the acquirer's interest, to sort of downplay what the multiples are somewhat. Let's see how that plays out. So that was brand number one. Brand number two is called Tech Fusion. It's again an FBA-led brand doing it's bigger. It's doing 10 million revenue and 1.75 million EBITDA. Slightly reduced on the FBA. It's 70% as it's bigger. It's beginning to diversify and become more omni-channel. So we've said 20% DTC and 10% retail. So of the 19 firms that were considering this brand, 15 bid. Again, probably even wider variance at the all-in multiple from 2x to 4x. 2x. I think 2x is crazy low for that type of brand. I think it's got to get up in the high threes or starting with a 4 all in. So the best bid was 4x. Nice and simple. 3x upfront, 75%, and a 1x earnout. Again, question whether would they be slightly higher, but it's interesting to see that we've gone and got 15 real examples. So lots of interest for this type of size of brand. Let's move to brand number 3, Luxhaven. So this is the largest FBA brand, doing 3 million EBITDA, 20 million revenue. So immediately you can see that only 9 of the 19 firms made a bid. So clearly a lot of aggregators are looking for smaller brands, as we know. Originally it was all 1-2 million revenue brands, but a lot of them have moved up the curve over the years. But few can take bigger chunks or bigger bites like this sort of brand would require. That's our first observation. Again, significant variance in the bids, ranging from as low as 2x all the way up to 5x. A clear winner there. So from a seller perspective, listening on this call, I think it's important that you work with a firm like us we know which of the buyers are willing to make, higher bids. And again, we're not saying that the highest bid's always the best bid. It depends on, the ability of the buyer to close the deal, deliver on the growth for the earnout, etc. And we have a good flavor as to who the best buyers are. So again, please reach out if we can be helpful. So they were the 3 FBA-led brands. So let's jump into the 3 DTC-led brands. And now, just a caveat, again, of the 19 respondents, most of them are FBA aggregators. Some do both FBA and DTC, but the quantum of responses for DTC is lower. Again, for our next quarterly report, we'll give more time and get more responses, but I think it's still interesting from a trend perspective. So this brand is doing 10 million revenue, 1.5 million EBITDA. So from an observation perspective, we think if we had 6 private equity firms make a bid for this as a bolt-on, the average would be much higher, be more towards the highest bid from what we're calling an aggregator, a TTC aggregator. We priced a deal of a similar profile in April this year at 7.1x EBITDA. So that's in our court to get a better representation of the acquirer market. But again, huge variety, as you can see. So it's important that when sellers go to market, going back to that deal dynamics slide, you need a really thoughtful marketing distribution strategy to make sure that you're approaching all relevant buyers. So as we go up the size on the DTC fictitious brands, this one is 20 million revenue and 2.5 million EBITDA. Net margins, have come down a little bit compared to other brands because the business is growing, and it's 70% Shopify, some offline and some Amazon. So again, similar to the prior brand, we think you can see the similar dynamics in terms of the range. The highest bid is 6.5, same as brand number 4. Again, we think we'd have more higher bids if there was private equity firms involved, which we'll try to do next time, but sort of between 6 and 7x. Again, all in, this is upfront plus deferred, but excluding inventory. We think that's in the right range. Okay, so the final brand is brand number 6, which is called Trend Hub. This is our largest TTC fictitious brand, 30 million revenue, 10% EBITDA margin, so 3 million EBITDA, and 60% Shopify, good retail presence at 20%, and 15% Amazon FBA and that should say 5% other. So again, there's only 3 bids. So a bit like the FBA, the aggregators are more set up for relatively smaller brands. And again, when brands become this size, they've earned the right to go to strategics and private equity. And that's how we get the number of bids up, and we'll get more mock bids from those folks when we go again. But again, huge variance just from a small sample of three bidders. So they're the bids for 6 specific brands. We also thought it'd be helpful to ask those 19 firms what they think is the highest multiple they pay for the perfect brand, which is what we call diamonds. Just to get a sense as to like where how far can they be pushed for the perfect brand. From an FBA perspective, the range given was 3x to 6x. Now, to be really clear, most people were sort of in the 3.5 to 4.5. There was just one firm saying 6x. So I would say, in terms of the median, it's about 4.5. That's the sort of the top end of the market right now. But if there are diamonds, maybe with an amazing repeat revenue rate in the pets category, going back to John's point, where there's huge growth, etc., then it has a chance to outperform a typical multiple. On the DTC side, it's 5x to over 10x, and I think there's plenty of examples of brands that can get over 10x, especially if they got exclusively recurring revenue. So the ranges that we'll present in a moment, include thoughts on what the perfect brand is. So let's jump to that. So where are we today in Q3? Obviously, pre-correction, the highs of December 2021, some of the Amazon FBA brands were getting priced up to 7x. That multiple has come down this year. In our last quarterly report in Q2, we were saying that typical brands were trading between 2x to 4.5x upfront and deferred, excluding inventory. If we include diamonds, based on our survey, we're saying now that the range is 2x to 6x. Again, the criteria to be a diamond is very, very strict in our definition, and not easy to obtain. Just to be clear, not every good brand is going to get 6x at all. From a DTC perspective, pre-correction, lots of brands were trading it up to 12x. Again, some above that. In Q2, our last quarterly report, it was 2x to 10x. And what we're saying today is it's 2x at the bottom for frankly distressed DTC brands who are not getting good CACs, etc. But there are potential for brands to price above 10x again if they have recurring revenue and those factors we mentioned from a diamond perspective. So I do hope that was helpful. Thank you again, Ben, for the idea. We welcome feedback to keep iterating, keep improving how we approach analyzing valuation trends, both from sellers and buyers, and we'll keep getting a better, more granular as we go into Q4 and beyond. Okay, so we can jump to audience Q&A. We have maybe 2 or 3 minutes to do Q&A. If I can ask John and Dan to turn on their cameras, we can look at some of these questions. There's a question, is this bid multiplier from firms against LTM or EBITDA? Yeah, it's against last 12 months EBITDA. That was what we were asking people to bid on. I'm trying to think, considering both private equity, dry powder, updated valuation conditions for brands and other factors such as uncertain macro, do you expect aggregator activity to tilt towards a deal acquisition, revamp to grow their own portfolios, or further industry consolidation? Great question. We had a conference in London for acquirers only 4 weeks ago, and 2021 was the year of acquisitions. 2022 was the year of the correction. 2023 is the year of operational performance, and hopefully 2024 is the year of a lot more aggregators going back to, obviously they'll focus on organic growth, but more inorganic growth. I think we've run out of time. We only have 1 minute left. Those questions that we haven't answered, we will endeavor to answer via email as part of the follow-up. So that leaves me just to thank John from Grips and Daniel from Theta for your great insight. Love the data-driven approach that you guys do, and thank you for everyone attending. Again, we'll send out the recording and the PDF of the document as part of the follow-up. So appreciate your time, everybody, today. Have a super day. Thank you. Bye-bye.